Are you prepared for the unexpected twists in today's financial markets?
Absolutely. Top analysts like Emily Brown, David Lynn, and Graham Stephan are here to guide you through the chaos.
We've distilled their extensive analyses into bite-sized summaries that will save you time and enhance your investment strategy.
Stay tuned as Emily tackles the risks of equity corrections, followed by Graham's take on Trump's game-changing revenue proposals.
And wait till you hear what Stephanie has to say about the future of investing.
Ready to navigate the changing tides? Let's get started. Remember, knowledge is your best asset.
In today's review, we focus on the insights from Emily Brown regarding current market trends, as discussed with David Lynn.
Emily provides critical analysis on the state of equity markets and the economic challenges we face.
Emily Brown identifies substantial risks for equity markets this year, predicting a need for caution among investors.
Her analysis suggests that market corrections are imminent, particularly in high volatility sectors.
Emily explains that rising Treasury yields are increasing borrowing costs, which could put additional pressure on equity valuations.
This increase in costs is particularly troubling for growth stocks, which investors may view as riskier in a rising rate environment.
What does Emily predict for the market correction this year?
Emily predicts an impending correction of 15 to 25%, a significant dip that could shake investor confidence.
According to Emily, we should expect market volatility to persist, creating fluctuating opportunities for investors.
Emily encourages investors to brace for these shifts, emphasizing the importance of strategic positioning.
In conclusion, Emily suggests that investors need to keep a vigilant eye on rising yields as part of their strategy.
Moreover, understanding the potential for market corrections can navigate challenging times effectively.
David's discussion underscores the need for proactive planning in light of these insights. Today, we're discussing Donald Trump's proposal to eliminate federal income taxes as part of Graham Stephan's analysis.
This proposal could have sweeping effects on tax obligations for many Americans.
Graham Stephan highlights Trump's recommendation to completely remove federal income taxes.
This raises concerns about potential negative impacts on public services and the federal debt.
What potential benefits and drawbacks might arise from canceling income taxes?
Graham mentions that while there could be a boost in consumer expenditures, the government may face significant funding challenges.
How are different political factions responding to this proposal?
Graham observes that while this resonates with Trump's supporters, many politicians are skeptical about implementing such a sweeping policy.
What outcomes might stem from this tax cancellation proposal?
Graham predicts a scenario where families could see more disposable income, but warns of the risks of heightened national debt and fewer public services.
In conclusion, Trump's proposal to cancel income taxes could reshape the economic landscape, warranting close attention to political and economic responses.
Graham underlines the importance of assessing economic predictions to understand their potential impacts on Americans and the economy.
Today, we're examining an analysis by Stephanie Pomboy, discussed with Adam Taggart, about the imminent changes in investment strategies.
Stephanie explains that the way we invest is likely coming to an end, urging a reevaluation of traditional approaches.
Stephanie Pomboy believes that the conventional methods of investing are being challenged by new economic realities.
Adam Taggart notes that this perspective aligns with the increasing volatility in financial markets. Stephanie identifies rising economic uncertainties as a significant factor affecting investment decisions.
These uncertainties call for adaptability in how investors approach the market.
Stephanie stresses the critical importance of flexibility in adapting to new market conditions.
Adam adds that being informed and responsive is crucial for contemporary investors. Stephanie suggests that investors re-examine their traditional investment methodologies in light of these current challenges.
This reevaluation could lead to fundamental changes in how portfolios are constructed. What does Stephanie predict for the future of investment strategies?
Stephanie forecasts a significant shift towards alternative investments, as traditional methods may no longer suffice. In conclusion, Stephanie emphasizes that staying informed is essential as market conditions evolve.
Flexibility in adapting strategies will be integral to navigating these new investment realities. Today, we explore Emily Brown's analysis of alarming trends in the job market.
Emily warns that discrepancies in job statistics could affect economic stability and investor confidence.
Emily Brown believes that inconsistencies in job data pose a significant concern for the economy.
David Lynn agrees, emphasizing that such issues may reduce trust in the job market. Emily asserts that unreliable job statistics can hurt investor sentiment, crucial for economic recovery.
Certainly, without reliable job data, investors might refrain from making major decisions. What does Emily say regarding economic warning signs?
Emily points out that inconsistencies could foreshadow potential challenges for the market. Emily emphasizes that cautious investment strategies are key in light of the current data.
What strategies could investors explore?
Emily suggests reviewing investment diversification and monitoring key economic indicators.
What predictions do Emily and David have for market reactions?
Emily anticipates more volatility as the market integrates these unexpected developments.
How should investors adapt to Emily's insights?
Emily advises staying informed about job market indicators and remaining flexible in strategies.
The clear takeaway emphasizes that vigilance and adaptability remain essential for investors in this climate. Today, we're diving into a significant report from Redfin highlighting a massive decline in investor activity in Florida's housing market.
The analysis from the Reventure consulting team points to a staggering 65% drop in home sales, revealing deep concerns about the real estate landscape.
The Reventure consulting team identifies a significant concern. Home sales in Florida have plummeted by 65%.
This unprecedented drop suggests a severe withdrawal from the investor market, which might indicate broader economic distress.
The Reventure consulting team's analysis reveals that Florida's investor home purchases are experiencing a notable retreat.
This downward trend signals heightened uncertainties in the market, contributing to the sales drop. The decline in investor activity could lead to a ripple effect in the housing market, impacting property values and increasing vacancies.
Reventure Consulting suggests that this shift may unsettle buyer confidence and lead to further market corrections. Looking forward, what does the Reventure Consulting team predict for Florida's housing market?
They anticipate that if these trends persist, we might see a continued decline in home sales, with recovery depending on a resumption of investor activity.
To summarize, the Redfin report brings significant insights into the current trends of Florida's real estate market.
Reventure Consulting advises investors to approach with caution amid rising uncertainties and to closely monitor market signals for potential stabilization.
Today, we're analyzing inflation management strategies with Emily Brown.
Emily suggests that central banks might let inflation run high, significantly affecting cash value.
Emily Brown proposes that central banks might intentionally allow inflation to rise.
According to David Lynn, this could lead to a substantial decline in cash value. Emily highlights that existing policies may not effectively curb rising inflation.
What does this mean for consumers and investors?
Consumers should prepare for increased prices and market uncertainty.
David Lynn mentions that inflation will shape how investors approach their portfolios.
Emily discusses a possible shift towards inflation-resistant asset classes.
Emily predicts that unchecked inflation could significantly reduce cash buying power.
David adds that this trend will drive investors to seek more secure assets.
Emily concludes that households should prepare for ongoing price increases.
She stresses the necessity for investment strategies to evolve to incorporate inflation risks.
In summary, both consumers and investors must adapt to this changing economic environment. What an incredible journey through the minds of financial experts we've had today.
Absolutely. Emily Brown, Stephanie Pomboy, and the Reventure consulting team provided us with a rich tapestry of insights.
It's particularly eye-opening that they all share the notion of a volatile financial landscape requiring investors to adapt.
Exactly. But as we've seen, there's some disagreement too. Emily sees inflation as a persistent issue, while Stephanie urges caution about economic recovery timelines.
And don't forget the stark warnings from the Reventure consulting team about the housing market. A 65% drop in home sales is monumental.
It certainly raises a lot of questions moving forward about the macroeconomic impacts.
Let's not overlook Donald Trump's proposition on eliminating federal income taxes, which adds yet another layer.
Indeed, all these differing perspectives really emphasize the complexity of today's economic challenges.
If you found this discussion enlightening, be sure to give us a thumbs up and subscribe.
Your input helps us bring more in-depth analyses and important discussions your way.
Be sure to catch our next video where we explore how global events can ripple through local economies.
You won't want to miss it. Thanks for watching.